There is more to impact investing than that it's about generating financial and social returns at the same time. In particular, there's a lot of confusion about the exact instruments that are applied in impact investing and social finance, and that is exactly why we portray some of them here. Equity designates an investment case where the social investor acquires a part of the social venture. So the investor moves right into the organization. While the investor brings the benefit of her vast network of contacts, for example, she will also have her own priorities. If these are more of a financial rather than an impact nature, the investor's priorities might run counter to those of the venture. This is why, especially in equity investments, it is important that the values of the investor and the social venture are aligned. The second finance option are loans, which might carry some interest, or grants, which might not even require repayment. Finance of this type, which is of particular importance to social ventures wanting to scale their impact, are what I would call accelerator loans or grants. They can be provided by foundations who want to help kickstart an innovation or establish beacon projects that serve as orientation and role models for others. Then there is a growing number of dedicated accelerator programs that do not only provide money, but offer mentoring and targeted support to develop the ventures. Innovative crowdfunding platforms are following a similar idea. Instead of gathering money for a one-off chance for an idea to succeed, they seek to provide institutional support, for example by matching ventures with a lead crowd investor. The principle behind this is that ventures move from a great idea to a viable organization and from grants to long-term investments. Such crowdfunding platforms are most interested in enterprises with a potential to scale impact. Swarm Intelligence, a venture based in Colombia, is currently seeking to fund the buildup of a digital knowledge base by which fish farmers across the country and beyond can increase their productivity while reducing their environmental damage. Instead of trying to improve the practices of a selected few, their value proposition lies in changing farming practices more widely. There are two further impact investing or social finance options that lie in between loans and equity. The first one are so-called convertible loans, where a loan transforms into the option for the provider of the loan to acquire equity. Two relevant criteria when this option materializes are when the venture has reached break-even or when it has successfully reached predefined impact goals. The second option, and one that is really quite recent, are special mezzanine finance products. They are typically composed of three components. The first one is a loan with a repayable interest of X%, which is usually a below market rate return. Only after break-even would the venture need to repay an additional fixed income component of Y% or be required to sell a share of equity to the investor. This gives entrepreneurs a grace period in which they can fully concentrate on building the venture under low financial restraints. A third reward or punishment component is added to make sure the ventures stay on track as regards their social mission. If the ventures meet their impact criteria, they do not need to repay an additional interest. However, if they miss those criteria, for example, when they are subject to mission drift and seeking profits rather than impacts, they would be required to repay an additional percentage. This way, working towards impact is also financially beneficial for the venture. Finally, we have so-called social impact bonds. It has often been criticized that these are not bonds in the traditional sense, but rather public-private social venture partnerships. The idea behind them is that a private investor chooses to invest in a social venture or a coalition of ventures, which by means of this investment are ideally able to provide an innovative service that hasn't existed before. The hope is that this will lead to improved social problem solving. Whether this is actually true is checked by an impact assessment, which is often performed by academics, but also needs to be legally approved. If the impact criteria aren't met, The investor who carries the risk of failure loses her money. Upon meeting predefined impact key performance indicators instead, the investor is compensated by the government, including a premium on the investment. This shows that impact investing and social finance work quite like traditional finance in many regards, but also that finance vehicles employed in this area embrace some innovative, impact-oriented principles that could affect finance at large.